Well, good morning to Sara Hsu in New York, Japan in China, and for other people watching us, although it might be quite a challenge. This is the China Hangout, and we have been not been doing this for a while, so we are stumbling in some technical difficulties, but it seems to be working now. My name is Fons Tuinstra. I mostly run the China Speakers Bureau, and Sara is actually one of our speakers, and we decided it was time to wrap things up on China's finance. She's a financial analyst and has been writing quite diligently in the past months, like sometimes twice a week, a decent analysis of China's finance. So it was time to get our act together. We are yes. There are actually some tools to, if you go to our website, you find very easily back some of the stories Sara has been writing. But Sara, we talked last year extensively about shadow banking and debts in China. Since then, you have been writing a lot, and one of the first questions I want to ask you is: mostly I can divide economists up in when they talk about China about bears or bulls, and you seem to have a bit of both. How would you qualify yourself at this stage?
Well, I wouldn't classify myself as either a bear or a bull per se. But one thing that we did realize during the run-up in shadow banking debt was that there was going to be some sort of a fallout. And so a lot of analysts who were looking at shadow banking in China predicted that this would happen. There would be an economic decline because most of the growth was fueled by shadow banking. And so we were rather bearish on China's economic outlook because of that. And we see that today this has come to fruition. There is a decline in GDP growth, which the leadership is trying very hard to maintain. But it's difficult because there are few other sources of GDP growth. So this is the predicament that they face.
Yeah, a bit about the bear and the bull, depending on whether you're a bear or a bull. Some people say that the government is trying very hard to push the economy to the 7.5% growth level of this today. Others say it's actually trying successfully to slow down the economic growth. What's your position on that? What do you think the government wants to do, and is it successful in that?
Well, the government has indicated that they don't want to maintain economic growth at any cost, that they do want to implement reforms. And to that end, they've also been trying to use targeted monetary policy and sort of creative monetary policy in terms of injecting loans into some of the larger banks for targeted spending in industries that they would like to promote. At the same time, we haven't seen a lot of reforms in the areas that they most need them in, such as urbanization and in healthcare. And so it's hard to say exactly what their ultimate aim is, if it's to stop the slowdown in growth or if it's to promote reforms. It seems to me like they're trying both, and that's a really hard thing to do.
You think because I'm in Europe and people are here dreaming from well, they only have at best 1% growth. Why should China be unhappy with 7.5% growth?
Well, they need to maintain growth in order to keep their economy moving. If there's a slowdown, then people start to potentially face unemployment, and then they would not be able to achieve the reforms that they've targeted.
Okay, but the very bearish predictions from last year that shadow banking would be causing an actual slowdown, it has not been materialized. Eh? The shadow, Well, also there are conflict. I just saw last week that IMF is warning for the growth in shadow banking in China, which is now up to 7 trillion US dollar or something like it. On the other hand, the major collapses that people expected have not occurred.
Yes, so that's something that's really interesting. The basic reason for that is that the government has stepped in at the last minute and bailed out products that were potentially going to default. And this includes both the local governments, which we've seen a lot of in terms of bailing out trust products, and also we've seen the central government, even in the case of China, credit equals gold #1. In that case, we saw the central government step in and help to bail out the wealth management product, which was essentially based on a trust loan.
Okay. But then the original fear, the fear was, at least last year, was that the government would not step in, although the government has stepped in every time when a bank in China got into trouble or a financial institution. So
yes, so this is something that we see, and the government had warned explicitly that this was not going to happen. They said, we're not coming in to bail out trust companies. We're not coming in to bail out wealth management products. And in essence, this is what has been happening. And so it seems that indeed the government is the lender of last resort in this case. It continues to be, which poses a risk going forward of moral hazard building up in the financial sector as lenders believe that they can continue to extend loans however risky they are. But what we see now is that it's more and more difficult for the lenders to find good sources of lending. I spoke with a trust manager in China the last time I was there, and he said that most of the incomes of the trust managers are based on commissions, and they are basically making, just enough to survive. And so things are really starting to slow down. And it seems that we may see some additional government bailouts because a lot of the local governments are bailing out the trust products. And the trust companies, the local governments are going to be able to roll over their debt into municipal bonds. We see that some of this debt may just keep going on endlessly.
Okay, so but I should also introduce Chopin. He's an economist in learning, and maybe wants to join also in with some questions. Anything to ask here, Chopin?
Well, first, let's test. Can you hear me now? Because I have some.
Okay. It's not very clear. It's not very clear. You can also. Yeah.
Now is it better now? I put it.
Yeah, it's a bit better. Yeah.
Okay, great. So, well, basically, I think the Chinese economy since 2008 was based on the credit expansion. The government inject the liquidity in the bank and to boost the housing sector. So that the whole problem is just lasting till now. Now the banking also facing the so-called liquidity risk of the financial crisis, but it's just the credit expansion. And now the government are talking about whether to bail out or not. Well, it's certainly the government cannot just print money to solve the money which created by the more money was printed. So government claim that not to step in, but it seems like the government still have an itchy feet, want to fix the market by bailing out the bank and injecting the liquidity. Well, I don't think that is a way to solve the real problem.
Well, maybe we should ask Sarah, because Sarah, you mentioned just now also the municipal bonds. That is a new way of getting more money. Is that a way out of the mess?
It's not. It's just basically, and Chao is right, it's basically recycling the debt. because you're taking the local government's debt, which was incurred either directly from the local government or through the local government financing vehicles, which are arm's length vehicles from the local government. And you're taking it, you're issuing municipal bonds, and the local banks are buying the municipal bonds. They're also associated with the local governments as well. And you're not seeing rates of return that reflect the actual risk of the debt itself. And so this is really problematic. What we may see over time is the local government asset management companies, or even the national asset management companies, taking on a bunch of bad debt that's incurred from this process. And a lot of it, as Chao mentioned, comes from the 2008-2009 stimulus package, which encouraged a lot of bank lending. And lending occurred especially to the real estate sector. Most of the growth in the debt was in the corporate sector and also somewhat in the local government sector as well. And a lot of it was focused on real estate. So as the real estate asset prices decline, something has to be done about those bad debts. And it's most likely that the government, either local or central, is going to end up footing the bill for that.
Who's going to pay the bill for that? Because that's important. Sarah? I didn't get the last one.
Well, either the local governments or the central governments. So essentially the asset management companies are probably going to end up being responsible for this bad debt.
Yeah, because China has quite some experience in dealing with bad debts.
Right.
In last century, it were also the major state-owned banks who got their asset management companies, and they worked away. They worked away quite a lot of the bad debts. Is that not a possibility for municipal debts too?
Yes, I think it is a possibility, although the underlying problems in the financial sector will not be eliminated through this process. There's a huge problem with moral hazard. There are lots of problems in terms of local officials having to prove that they're producing GDP growth, and they're not necessarily profit-oriented or market-driven, which means that their debt is not priced correctly, the risks are not appropriately accounted for. So we really have a muddle that is continuing here.
So what do you, because you mentioned reforms, obviously the municipal bonds are a bit of a reform, but only say to stop the heavy, well, to prevent the patient from dying. What do you think is really needed to get China out of this mess?
Well, I think some real pricing of risk, which could be reflected in interest rate, a better ratings system, and eventually they have to incur some sort of real structural reform that changes the economy from a low-cost labor manufacturing-based economy, which they've already turned away from, towards a more service-based and high value-added manufacturing economy. And so they've turned away from their base of comparative advantage. They've got to turn towards something that is essentially more profitable.
Okay. So essentially China needs more real bankers.
Yes, I suppose so.
Okay. Now, because I saw that now also some of the internet companies like Alibaba and Tencent, they started their own private banking enterprise, and they are now massively hiring bankers on that market. Is that they're not undermining the state banks if they lose their best people to the new private banks?
Well, the state banks still face constraints in terms of giving loans to the state-owned enterprises, and there's a huge market out there that's relatively untapped. Unfortunately, the small and medium-sized enterprises are labeled riskier than larger enterprises because they don't necessarily have the credit history or collateral that larger enterprises have. So if Alibaba and Tencent can tap that, that's a huge opportunity for them.
Okay, now that would be a major change in maybe also the pricing policy, the changes in pricing policy that's needed to deal with the risks. Have you already any idea on how these private banks are they still marginally, or do you think there will be real competition for the state banks?
Well, the private banks may cater more to the smaller and medium-sized enterprises. And so to some extent, there may be competition, but I think that they may attempt to look at a different market.
Okay, so there's in that way not real competition. Now, I've been hearing a lot about reforms in China. Well, the last one was the Shanghai Free Trade Zone, and if I can believe some of the media reports, which I of course should not, then it's on a dead track. The Free Trade Zone are reforms in general? Has it been like we saw the previous regime was in its first year very active in making all kind of promises and didn't do anything for the next 9 years. Is there a fear that a similar thing is going to happen to the current government, that they just made a lot of nice noises and we have to, nothing is coming out of it?
Well, I'm starting to see some analysts, including me, wonder about that, and I haven't really seen major reforms which would change the economy to a more service-based economy and to a more consumption-based economy. I think this is a very difficult process, and it seems that the leadership is more focused on combating the economic slowdown, which they actually say that they're focused on reforms and not the slowdown per se. But based on what they have been doing in terms of many stimulus policies, they've been focusing more on the slowdown.
Okay, and they hope to outgrow maybe the problems then.
Perhaps.
That would be tough. Xiaopan, any questions there?
Yeah, I want to ask you a question about the interest rate liberalization, because the Chinese government are saying that they are trying to make the interest rate liberalized, like the market decides interest rate, but the process it seems like doesn't have a huge step now. I know the loan interest rate has been somewhat market liberalized, but the saving interest rate haven't have a real process. What's your take on that, the liberalization of the interest rate?
Right. So a lot of economists are hoping that the interest rate regime will be fully liberalized, and this would allow better pricing of risk. This would hopefully allow corporate bonds and other instruments to be better priced, which right now they're underpriced for risk. And so I think that the deposit interest rate would have a lot of knock-on effects to other interest rates and help to open up the rest of the interest rate regime as well. But we would have to see at the same time better accounting for risk and better credit ratings. And essentially the institutions that are responsible for rating risk would have to be upgraded and would have to have less of an incentive to downplay risk than they currently do. And so that would also have to occur at the same time.
So what that looks like a big wish list. What do you expect for the coming months to happen, Sarah? What's going to be on the agenda?
Well, I think that so we've expected to see a lot of trust defaults, a lot of shadow banking defaults, and that simply has not happened. And because of that, because we know that a lot of the loans were extended to the real estate sector, likely we'll continue to see a slowdown in the shadow banking industry, and we'll see some non-performing loans increase. The asset management companies will probably play a larger role, maybe very quietly and in the background. And at the same time, the leadership will probably continue to try to push forward some reforms, but I don't know how impactful they will be. We'll have to wait and see.
Okay. Well, it looks like maybe the collapse that people expected at the end of last year didn't occur, but the situation doesn't look like very rosy, to put it mildly.
That's certainly true. So because there are so many bad debts, the government has to somehow get rid of those. We know that the private sector may not necessarily be able to do that because the market doesn't quite function as a full marketized financial system. So we're going to have to see those bad debts go away before we can see some real growth happen.
Okay. Well, that's nice. Maybe we should end on this slightly bearish mood and see if there are in the coming months, because you will be writing a lot. I assume also if there's room for some bullish approach. Well, thank you, Sara, for joining us here, and Chopin for your questions. And we will be back soon, although I'm not sure when. And we hope to have then a few less technical problems than we had this time. Thank you very much, both of you.